I need to tell you about a crisis that is building in corporate America right now, and almost nobody outside of credit markets is paying attention to it. $2.1 trillion in investment grade corporate debt is maturing between 2025 and 2027. That is not total corporate debt. That is the amount coming due, the amount that must be refinanced or repaid in the next 36 months. Here is why that number should concern every person who owns a 401k, a pension, or any equity in the stock market. When these companies borrowed this money 5 to 7 years ago, interest rates were near zero. The average coupon on investment-grade corporate bonds issued in 2020 was approximately 2.5%. Today, to refinance that same debt, companies are facing rates between 5 and 6%. That is more than double the cost. This is not a liquidity problem. This is a solvency problem disguised as a refinancing challenge. And in 50 years of studying debt cycles, I have learned that solvency problems do not resolve themselves quietly. They cascade. Subscribe now, because what I am about to explain is the exact mechanical sequence that precedes every major corporate debt crisis in modern history. And the investors who understand this sequence are already repositioning their portfolios before the defaults begin. Here is how we arrived at 2.1 trillion in maturing debt. Between 2014 and 2021, during the longest period of near zero interest rates in American history, corporate America went on a borrowing binge. They issued bonds to buy back stock, to fund acquisitions, to refinance existing debt at lower rates, and in some cases, simply to hold cash on the balance sheet, because borrowing at 2% and earning 3% on cash was free money. Investment-grade companies rated BBB minus or higher by credit rating agencies, issued over $6 trillion in new bonds during this period. The debt was cheap, the covenants were loose, and the assumption that every CFO and every credit analyst was making was that rates would stay low indefinitely, or that the company's cash flow would grow fast enough to service higher rates if they rose. Neither assumption held. The Federal Reserve raised rates from 0 to 5.3% in the fastest hiking cycle in 40 years. And corporate cash flow growth, which averaged 4 to 5% annually during the 2010s, has slowed to 2 to 3% as the economy decelerates and margin pressure builds from higher input costs. Now the debt is maturing, and the math of refinancing is brutal. A company that borrowed $1 billion at 2.5% in 2020 is paying $25 million per year in interest. If they refinance that same $1 billion at 5.5% in 2026, the annual interest expense rises to $55 million. That is an additional $30 million per year in cash that must come from somewhere, either from operations, from cutting capital expenditures, from reducing dividends, or from selling assets. Here is the critical number. Of the 2.1 trillion maturing between 2025 and 2027, approximately 800 billion is held by companies in sectors with declining or stagnant cash flow: retail, commercial real estate, legacy media, traditional automotive, and energy infrastructure tied to fossil fuels. These companies do not have 30 million in extra cash flow. They are barely covering their current debt service. This is the zombie company problem. A zombie company is defined as a company whose earnings before interest and taxes do not cover its interest expense for 3 consecutive years. By that definition, approximately 15% of publicly traded investment-grade companies in the United States are zombies. They are alive only because debt has been cheap enough to refinance repeatedly without ever having to repay principal. When refinancing costs double, zombies die. And when zombies die in sufficient numbers, the contagion spreads to healthy companies through 3 transmission mechanisms that I have watched operate in every debt crisis of the last 50 years. Transmission mechanism 1, credit market seizure. When defaults begin, bond investors become risk-averse. They stop buying new issuance from any company in the affected sector, even healthy companies, because they cannot easily distinguish between a company that is temporarily stressed and a company that is structurally insolvent. The market freezes. Healthy companies that need to refinance cannot access the bond market at any price. Transmission mechanism 2, equity market repricing. When a company cannot refinance its debt, it faces three options: sell assets in a distressed market, cut dividends to conserve cash, or dilute equity by issuing new shares. All three options are negative for equity holders. The stock price falls, and because investment-grade corporate bonds are held primarily by pension funds, insurance companies, and mutual funds that also hold equity, the losses in bonds trigger selling in stocks. Transmission mechanism 3, banking system exposure. Regional banks and mid-sized commercial banks have significant exposure to corporate credit through revolving credit facilities, term loans, and lines of credit. When companies default on bonds, they often default on bank loans simultaneously. The bank takes a loss. The loss reduces the bank's capital. The reduced capital forces the bank to tighten lending standards, which reduces credit availability to other companies, which accelerates defaults in a feedback loop. I have watched this sequence play out in 2001 during the telecom debt crisis, in 2008 during the financial crisis, and in 2020 during the COVID shock. Every time the pattern is identical: cheap debt fuels over-leverage, rates rise or cash flow falls, refinancing becomes impossible, defaults cascade, and the investors who thought they were holding safe investment-grade bonds discover they were holding leveraged bets on the continuation of zero-rate policy. Here is the timeline. The maturity wall begins in earnest in the second half of 2025. Approximately $400 billion in corporate debt matures in the 12 months between July 2025 and June 2026. Another $600 billion matures between July 2026 and June 2027. The remaining $1.1 trillion is spread across 2027 and early 2028. The first wave of defaults will likely occur in late 2025 or early 2026 among the weakest issuers. Retail companies with declining foot traffic and e-commerce competition, commercial real estate companies with office properties that are 20 to 30% vacant, legacy media companies losing subscription revenue to streaming platforms. These are the sectors where cash flow has already turned negative and refinancing at double the cost is mathematically impossible. When the first wave of defaults hits, the credit rating agencies will downgrade other companies in the same sectors, from investment grade to junk. That downgrade forces institutional investors who are mandated to hold only investment-grade bonds to sell. The selling drives prices down and yields up, which makes refinancing even more expensive for the remaining companies in the sector. The feedback loop accelerates. Here is what this means for your 401k. The average 401k holds approximately 40% of its assets in bond funds, target date funds, or balanced funds that include corporate bonds. If you own a Vanguard Total Bond Market Fund, a Fidelity Investment Grade Bond Fund, or any target date retirement fund, you own a portion of this $2.1 trillion in maturing corporate debt. When defaults begin, the net asset value of those funds will decline, not catastrophically, not overnight, but steadily as the funds mark down the value of bonds that are downgraded or default. A 10% default rate on $2.1 trillion in debt is $210 billion in losses. Those losses flow through to the bond funds, which flow through to the balanced funds, which flow through to your 401k balance. And here is the part that most retail investors do not understand about bond funds. When a bond defaults, the fund does not get repaid at par. It gets repaid at the recovery rate, which for unsecured corporate bonds averages 40 to 50 cents on the dollar. A bond fund holding 100 million in defaulted bonds recovers 50 million. The other 50 million is a permanent loss to the fund's net asset value. Your 401k statement does not show you this loss in real time. It shows you the fund's net asset value, which declines gradually as the fund marks down its holdings. By the time you notice the decline, the loss has already occurred. And because bond funds do not trade like stocks, you cannot easily exit without selling at the reduced net asset value, locking in the loss. Here is what I am doing with my own capital based on this analysis. I am reducing exposure to corporate bond funds, particularly those with significant exposure to retail, commercial real estate, and legacy industrial sectors. I am increasing exposure to short-duration treasury bonds, which have no credit risk, and to money market funds that invest in government securities rather than commercial paper. I am also increasing allocation to equity in companies with net cash positions rather than net debt positions. A company with $2 billion in cash and zero debt cannot face a refinancing crisis. A company with $2 billion in debt maturing in 2026 and $500 million in cash is at severe risk if the bond market freezes. The institutional investors I speak with are watching two specific indicators to time the beginning of the default cycle. First, the high-yield credit spread. This is the difference between the yield on junk bonds and the yield on treasury bonds. When the spread widens above 600 basis points, it signals that credit investors are pricing in a significant increase in default risk. The spread is currently at 450 basis points. A move to 600 would be the early warning signal. Second, the investment-grade bond issuance volume. In a healthy market, companies refinance maturing debt months before it comes due. In a stressed market, companies wait until the last possible moment and hope for better conditions. If issuance volume in the second half of 2025 is significantly below the amount of debt maturing, it means companies are struggling to access the market. That delay is the tell that refinancing is not happening smoothly. When both indicators flash red, the high yield spread above 600 and issuance volume significantly below maturities, the default cycle begins. I expect that inflection point to occur between Q4 2025 and Q2 2026 based on the maturity schedule and the current trajectory of interest rates. Here's the scenario that concerns me most. The Federal Reserve, seeing economic weakness and rising unemployment, cuts interest rates in late 2025 or early 2026. The market interprets this as positive for corporate bonds because lower rates make refinancing cheaper. Corporate bond prices rally. Retail investors, seeing the rally, increase their allocation to corporate bond funds, thinking they are buying safety. Then the defaults begin. Not because rates are high, but because the companies are structurally insolvent and even lower rates cannot save them. The bond funds decline despite the rate cuts, and the retail investors who bought into the rally are holding the bag when the defaults cascade. This is the pattern I watched in 2001 and again in 2008. The Fed cuts rates, the market rallies. Then the defaults that were already baked into the system arrive on schedule, and the rally reverses violently. The investors who bought the rate cut rally end up selling at the bottom of the default cycle. I want to be clear about what I am not saying. I am not saying every investment grade company will default. I am not saying the corporate bond market will collapse. I am saying that 2.1 trillion in debt is maturing at double the original borrowing cost, that 15% of investment-grade companies are already zombies, and that the mechanics of how debt crises cascade through credit markets, equity markets, and the banking system are predictable based on historical precedent. The difference between a manageable refinancing cycle and a crisis is the margin of error. When rates are low and credit is abundant, companies can refinance even if their cash flow is weak. When rates double and credit markets tighten, only the strongest companies can refinance, the weakest default, and the defaults trigger the transmission mechanisms that turn a sector problem into a systemic problem. Your 401k is exposed because the bond funds in your retirement account are holding this debt. The funds are mandated to sell when bonds are downgraded to junk. The selling drives prices down. The lower prices reduce your account balance. And by the time the financial media is reporting on the corporate debt crisis, the repositioning window has closed. In 50 years of managing capital through debt cycles, I have learned that the time to reduce risk is before the crisis is obvious, not after. The 2.1 trillion maturity wall is public information. It is disclosed in corporate filings, tracked by credit analysts, and discussed in institutional investor meetings. The only question is whether you act on the information before it becomes a headline. The maturity schedule is set. The interest rate environment is known. The zombie companies are identifiable. The transmission mechanisms are predictable. The question is not whether defaults will occur. The question is whether your portfolio is positioned for them. Subscribe now, because the investors who preserve wealth through debt crises are not the ones with the best forecasts. They are the ones who understand the mechanics, recognize the pattern, and reposition before the cascade begins. The mechanics are clear. The pattern is repeating. And the maturity wall is not a future risk. It is a present reality that will start resolving itself in the next 12 to 18 months. The numbers are public. The timeline is known. The question is whether you reposition your 401k before the defaults make it obvious to everyone else.